All right, I hope everyone's having a great afternoon because we have a treat for you. Coming up next, we have a keynote called Looking Ahead, Southeast Asia's Global Debut. And in this session, Asia partners Nicholas Nash will discuss 2021's watershed events, including SPACs and IPOs, what global capital and international attention means for local tech and startups, the challenges and opportunities that firms can capitalize on, and global market conditions, what startup leaders should do to stay ahead. So let's bring on Nick Nash. Check this out.
It's a great pleasure to be with all of you here today and to share a couple of thoughts that my colleagues and I at Asia Partners have been thinking about over the last 7 or 8 months. I'm going to put a couple of slides on screen for today's conversation, but if folks have questions afterwards, please drop us a line. We'd be thrilled to continue the conversation with you offline or in person, as the case may be over the coming months. I'm going to share a few thoughts that are in some ways an update, an interim update to the thoughts that we produced back earlier this year when we put out our 2021 Internet Report. I grew up in the old days of Microsoft Windows, so think of this as kind of Windows 3.1 as opposed to a whole new version. We'll cover some of the same ideas we've talked about in the past, but with some updates from where we are here in the calendar year, and also a few new ideas into the mix. But before we talk about tech and before we talk about growth and value creation, I want to just emphasize again that all those topics are frankly subsidiary to the much more important topic, which is still the ongoing raging pandemic here in Southeast Asia and beyond. Thank goodness for the vaccine. Thank goodness for the incredibly tireless healthcare workers and first responders that are making the entire planet a little bit safer, one patient and one situation at a time. We're very grateful for what you're doing. What we'll talk about today falls in a couple of kind of core categories. Many of you know that we've had a couple of really sort of foundational pillar principles in terms of what we thought would be happening in Southeast Asia. We first put these out in 2018, and we've been refining them ever since, but it's helpful to kind of do a little bit of a plan versus actual in terms of how things are actually turning out. I won't go through every single one of these, but we'll touch upon a handful of them and talk about what's actually changed over the first 3 years into our prediction period. If I start with the first one around the concept of a golden age, this remains very much intact. You sort of see it all around, despite the awful ravages of the pandemic. Day by day, more people are going online. Day by day, you can sense a sense of optimism around what the next decade might look like, in as much as 2020 and 2021 have been hard hit by the pandemic. And I want to emphasize an important aspect of the golden age. It's an age that countries go through on their path towards even greener pastures. And today, some of the new ideas we'd like to share is what happens to countries as they enter the slab above the golden age, what we would loosely call the platinum age, and even the slabs 1 or 2 even beyond that. But if you think about why golden ages get so much of our attention and why we talk about them so much, it's for a very practical reason. Large companies emerge from the cauldron, from the anvil of the golden age. And you can see that in years past with the enormous growth of tech platforms out of China, out of Korea, and out of Japan. And the vast majority of current market cap, and we've updated these even since these pages were created to validate it, more than 50% of China's tech market cap and Korea's tech market cap is a product of the companies that went public, plus or minus a year, around this very brief period of time when China and Korea were in their golden ages. Ditto for Japan as well. And you might ask, well, why is that actually the case? Why is that happening? It's happening because this is a very unique moment in time. This is a chart from our 2019 study, but it's worth highlighting it again. This is the moment in time when you see very large rises, very large surges in the percent of affluence that is truly discretionary income. Wants have not quite yet become needs yet. Income is coming in over and above existing needs, and you're seeing a lot of very interesting dynamics in terms of how affluence is being built across these countries. Now, what's really interesting is to think about, as I mentioned earlier, what happens before and after the golden age. Well, the golden age is between $3,000 and $7,000 of affluence on an inflation-adjusted basis, current dollars. The silver age is where India and Bangladesh are roughly at right now. It's that tier just before The platinum age is right after, and the palladium age, if you'll continue with the metaphor, is right after platinum. Well, we've been thinking a little bit about how things evolve as you go through these different stages, and I want to give you a very practical example. There's been a lot of talk, particularly in Southeast Asia over the last several years, about the growth of the online consumer. It's within that, online cosmetics is a fairly big category, part of the broader cosmetics value chain. There are some fascinating historical parallels to what's happening right now in Southeast Asia. If you'll permit me, let's take a walk together down memory lane. The prevailing or the predominant and then really the standard bearer cosmetics company for Japan is, of course, Shiseido. That's a fun fact that Shiseido's first forays into international expansion, which for them meant leaving Japan, were actually into Southeast Asia back in the late 1950s, around when Japan had on this chart, sort of in the neighborhood of about 6,000, 6,500 inflation-adjusted dollars of affluence. Shiseido then proceeded to Hawaii, America, Europe, and Australia and New Zealand as they went towards global expansion of their brand. It's an interesting fact that K-beauty, the next curve, Korea after Japan on our Golden Age chart, also began, give or take, when Korea was around that zone of about, $6,000 or so in inflation-adjusted affluence per capita. That is really interesting. In fact, K-pop continues over the same period to the point today where it is a massive global phenomenon. And it isn't just beauty and sort of disposable or sort of consumable goods. It's also intellectual property goods, film and music, the origins of J-pop, soon followed by the origins of K-pop, J-film, J-manga. Now today, of course, everyone knows the most popular show on Netflix globally is a Korean drama, Squid Games. It gives you a little bit of a flavor for how there's predictability in this chart over long periods of time, and it makes us wonder who might be next. Our money is on C-beauty. There's going to be a really interesting trend of aspirational Chinese cosmetics companies, and we already see some of this through some of our portfolio companies and their exports into Southeast Asia. And in much the same way that J-beauty went into Southeast Asia around here, K-beauty went into South Asia around here, it's probably already very much the case that there are some emerging brands from China that are selling here, which may not be global household names yet, but are very much on their journey up the value chain, so to speak, as China's affluence rises in the platinum zone. But it's not just beauty and cosmetics products that give us a flavor for what might happen a little bit after the golden age. And I want to talk about what that means for pricing goods. Now, many folks that are listening to this right now will be very familiar with the concept of sachet pricing for fast-moving consumer goods, FMCG. And of course, for sachet pricing, with a clear environmental cost in terms of packaging and waste, consumer items are packaged into very small amounts. You can see the Tide sachets over here. You can see all sorts of other consumer products in sort of blister packs that can be consumed at a small amount for one simple reason. At the bottom and middle of the pyramids, families' levels of working capital are low. It's only in places like America and other advanced economies where people will buy an entire pallet load of stuff, drop it in their basement, and then consume it on an as-needed basis, but for a lower quasi-wholesale price. And when you think about the application of sachet pricing to tech, what's really interesting is to start all the way back in 1999 with the first major Asian item-based game. It was a game called Quiz Quiz that was developed by Nexon. It actually technically wasn't the very first item-based game in the world. That distinction goes to a game called Achaea in the US, but it didn't end up being that large a game, whereas Quiz Quiz and then its successor, not from a genre perspective, but from a game director perspective, became huge. MapleStory was one of the single most important, almost genre-defining games in Korea, in China, and in Southeast Asia. And you can see that all of these games sort of emerged in a roughly similar period of time. They were all item-based, not subscription-based. And interestingly, they were all below this blue zone over here. Now, this is different than the golden age over here that produces large tech companies. We have a very early hypothesis, and we would love for you to push back on us if you feel differently. But there seems to be an emerging set of data that we're coming across that suggests that when countries go from below this blue transition zone to above this zone, they start to shift from item-based pricing to subscription-based pricing. And this has great implications for business. If you think about Netflix and Hulu and so many other businesses that are built on a subscription basis, they live north of this line. And some of them have had some success in the emerging market world, but to a certain extent, they have not actually had as much population penetration off emerging markets as they have had in their core markets. Now, why might that be? Well, if you think about, for example, Netflix. Netflix does do differential pricing for its standard subscription plan across countries. You'll see here that India is at around $8.9 per subscriber per month versus Germany at about $15.9 per subscriber per month. And you might think that's great. That makes sense. India is a less affluent country. It ought to be at a lower price point. But when you index those data points to monthly GDP per capita across the respective countries, what appears is something fascinating. In India, it costs 4.85% of monthly pre-tax economy-wide GDP per capita. Now, some of that GDP is going to capital and some's going to labor. Off that labor, some may be into taxes or other essentials. You're paying a very large percentage of the average citizen's affluence to get a monthly subscription. Whereas if you look in the developed West, and we have a discontinuity in the chart here to sort of jump to more affluent countries, these we think of as the barnacles on the hull. They're almost so small relative to monthly affluence that you don't think too much about it in terms of subscription. Now, eagle-eyed watchers will say, well, hey, this is the standard subscription. What about the basic subscription? So we ran it for that as well. And even on a basic basis, you see that same dynamic of where here, this is just a really large portion of your monthly affluence, whereas here, again, it's the barnacle on the hull. What do you do with that insight? Well, we have an emerging hypothesis that just as content, consumer content, will have this bifurcation between subscription-priced content and item-priced content, we would argue that there's a pretty decent chance that software could also be priced in a similar dichotomy, a similar bifurcation. And we would be really curious to see from the community if anybody has some good examples of item-based software pricing, perhaps for small and medium-sized businesses, versus subscription software pricing, software as a service, which of course is all the rage on a global basis. So stay tuned. We'll keep thinking about this, and we'd love any input you have in terms of data points that you're coming across that might validate that emerging hypothesis over there. One thing is clear, though. In the emerging market, there is tremendous value creation to item-based pricing. Look at the market cap of Tencent a few days back, the market cap of Sea a few days back, $550 billion, $180-odd billion, compared to more traditional IP content-based businesses born in the West that were born out of either an upfront purchase, a large upfront purchase, or a subscription model. It is really interesting to see that actually very large companies are getting produced in the emerging market context that don't have that subscription basis of pricing. Shifting gears to the next IPOs, one of the things that we talked about back in 2018, 19, and more recently is that we felt there would be at least $10 more billion to go public in the next decade. So between 2019 and 29, or 2018 and 28. That was controversial and frankly a bit of a contrarian perspective. It's becoming more and more clear. Part of why is this chart, which we've now updated for today's conversation, where we look at the pitter-patter, the transition of how companies went from private ownership to public ownership in China over the past roughly one generation, culminating with the more recent IPOs of 2021, successful or otherwise. And what's interesting about this, again, is that Southeast Asia is very much following in a similar pattern of being just about 10 years behind China. There's the occasional compression of that gap. The delta between the DD IPO and the Grab de-SPAC will probably be measured in quarters, not years. But as a general drift, there is a bit of a time lag, and that gives us predictive power to be able to think about who might some of these next companies be to go public. Now, interestingly enough, Sea has led the way in many ways, and I'm just thrilled to see the success of Sea's business over a sustained period of time. If you were to look at the IRR, the internal rate of return, which is an annualized return for the world's largest companies, any country, any industry, any geography, and you look at companies that have at least $100 billion market cap, this is in fact the ranking from the beginning of 2018 to approximately last month. It's just fascinating to see that Southeast Asia has produced a company of this scale with this kind of sustained value creation alongside some wonderful businesses on a global basis all around the world. Who's next? Well, Bukalapak, credit to that wonderful team, has done a great job of going public in the IDX context. There's a number of other companies that are widely thought of as being likely. Grabs, DSPAC, probably a few quarters away. If all goes well, perhaps even less than that, a few months away. A few others on this page to keep an eye on. And we have perhaps a bit of a parochial view, maybe a bit of a biased view, but we would encourage all of you to keep your eye on these 6 companies that we have meaningful relationships with and know about from the inside as board members. And we'll tell you that on this list would clearly be, in our mind, some of the next as well that'll likely be hitting the public markets not too far in the future. One of the points that we find really interesting and we want to really sort of raise the awareness of is Indonesia's access to the US capital markets. It's an interesting fact that if you look at the 1990s, about 24% of all the capital raised from Indonesian IPOs was on the US exchanges, and about 3/4 of it was on the Indonesian exchanges. That was actually a higher ratio than all the capital raised by Chinese companies. About 20% raised in America and the remaining 80% raised betwixt China domestic and the Hong Kong exchange. What is so interesting is how that transitioned after the Asian financial crisis of 97, 98. It shrunk to Singapore getting a small sliver of capital raised by Indonesian companies in IPOs, and Indonesia primarily providing the rest in a domestic capacity. That is super interesting because the opportunity to reconnect that circuit from high voltage to low voltage, if you will, is a very, very powerful one in terms of capitalism and in terms of bringing much needed capital to the Indonesian ecosystem. In fact, if I redraw those same charts between the 1990s and the roughly 2 decades since, for just the tech industry, what is so interesting is that more than half of Indonesia's IPO proceeds came from listings on American exchanges. And that in many ways, I think, suggests that the future of Indonesian IPOs is not just going to be domestic, but perhaps dual listings, eventual cross listings, or even sole American listings as a de-SPAC might lead you to consider. So we want to keep an eye on this because actually this is a back to the future moment where something that was very prevalent and very logical in the past should indeed be continuing in the coming decades. We've talked a little bit in the past about how companies are getting built out from a regional dynamic. And we wanted to update some of these numbers to share with you the mix between what we call strategy 1, which is just focusing on Indonesia, and strategy 2, which is building a regional business, often from a home in Singapore or Malaysia. And if you update the numbers from our previous studies as of basically last month, what you find is that there's an even deeper concentration than in the past, just by a few percentage points, between strategy 1 and 2 versus all the other strategies combined. And this seems to be the market speaking, that it's really 2 clear paths for building very large companies and an emerging set of strategies which we hope over time will actually gain in prominence. We're particularly interested in what's happening in Vietnam and Malaysia in terms of building multi-country businesses from those emerging origin points for large company formation. Part of what has permitted companies to scale regionally is something which hasn't quite gotten enough attention from a media perspective, from a broader even investor perspective. We want to really highlight this topic, which is the importance of students going abroad, getting educated, making friends, and then coming back. It almost doesn't matter exactly where they're going abroad, as long as they come back with a broader social network, roommates, friends, whatever the case may be, who are representative of the broader Southeast Asian fabric. And one of the facts that we pay very close attention to is that within Southeast Asia, Vietnam has seen an absolutely meteoric rise in the number of students traveling to the US for undergraduate. I just interviewed somebody phenomenal just this afternoon for a position with HR Partners who's going to college in America right now, might be an intern for us, and comes from Vietnam. It's a really interesting fact. In fact, Vietnam, on a logarithmic chart, is starting to approach, where some of its neighbors to the west and to the north are, in fact, on a per capita basis. What's fascinating is that Vietnam is already sending more people to America than all of China, normalized per unit of population, and is actually now the second largest across Southeast Asia, second only to Singapore. This is true at the undergraduate level. Similar dynamics are prevalent at the graduate school level. We think this is a trend to watch because many of the founders of Southeast Asian platform companies were students who went abroad, made a bunch of friends, and came back. We would keep eyes on the Vietnamese returnees, many of whom are coming back with a much more regional perspective than entrepreneurs in years past. Definitely a trend to watch for the next 5 or 6 years. Now, it's not just the American universities, although those first two charts happen to talk about them. The Australian universities are probably the single most underreported story in Southeast Asia tech right now. In fact, if you just look at the graduates of the top 15 Australian universities, diploma holders, certificate holders, undergrad, masters, what have you, it's 2.3 times the number of graduates from the top American universities. Part of that is proximity, part of that is cost, part of that is just continuity, where people have been going down to Sydney and Melbourne and Perth for a long period of time. And really, with the exception of some of the American companies, in many of the leading companies in our region, the number of Australian university graduates far outnumbers the number of American university graduates, which is also a very, very important point. And layering in the British system as well, you begin to get a sense that actually there's really several clusters of university returnees, sea turtles, if you will, with diplomas on their heads. And over time, the Xinghuas and Beidas and Fudans and others, Shanghai Jiaotongs, will also contribute to this chart. So watch this space. It's a very important ingredient in how companies are getting formed. And it leads to a very dynamic over the longer term as people's careers develop, which is that we're seeing a fascinating trend where Singapore is becoming what we love to call the commercial capital of Asia, in the same way that Dubai is for the Middle East, London is for Europe, Miami is for Latin America, New York is for North America, and so on and so forth. This dynamic also portends something very important for the software industry. With this large a concentration of CX level or even managerial level decision makers with pan-Asia responsibility sitting in Singapore, we think it will be surprising if there isn't a very substantial enterprise software industry, homegrown, that develops in Singapore over time, with development capability in India and China and Australia and the Philippines and Vietnam and Indonesia and so on and so forth, but with sort of the home office and the head of sales sitting here in Singapore on a regional sort of development platform. Something to think about for the longer haul. Finally, many folks that have been chatting with us for a while know that we love slicing and dicing the supply and demand dynamics in Southeast Asia, to think about what are the different pockets of oversupply or undersupply of capital. And today what I'll share with you is a bit of a 4x3 grid. It's China, India, Indonesia, and the rest of Southeast Asia, not including Indonesia. So we can sort of isolate those out a little bit. And then what we love to call the small batteries, the medium-sized batteries, and the large batteries. $1 to $20 million checks, 20 to 100, and 100 plus. Now what's really interesting is if you look at 20 versus 19, and we've updated these numbers as new data points have come in, versus what we shared earlier this year, what you see is actually three very different patterns. In the case of China, in general, capital supply continued to grow between 2019 and 2020. In the case of India, there was a gradient. It was a lot easier to raise capital at the large end of the market, a lot harder in the middle end. And Southeast Asia was neither uniformly strong nor a gradient. There was a dip. There was an absolute decline in dollars deployed in the $20 to $100 million segment. Flat over here, up over here. And again, this is just private company tech fundraising, calendar year 20 versus calendar year 19. Now, what's interesting about it as well is if you think about isolating Indonesia from the rest of Southeast Asia, again, calendar year 20 versus calendar year 19, it actually was quite similar, all else equal, between Indonesia and the rest of Southeast Asia, excluding Indonesia, broadly consistent with the overall regional average. 21 has been different. In 2021, what's really interesting is, again, Chinese deployment has been very, very strong. This is specifically comparing calendar year 21 year to date versus calendar year 19 year to date. So you can get a little bit of a pre-COVID versus current stabilized perspective, hopping over the rather tumultuous year that was 2020. India, you continue to see the gradient. It's no longer negative over here, but it was definitely much more attenuated, moderately growing, and then very fastly growing. And then here you see, for the first time in our data in recent years, a real bifurcation. In Indonesia, small checks didn't grow that much between 21 and 19. Mid-sized checks exploded in capital supply. And we perceive that we're seeing some of that in the valuation environment in the middle-size stage of the Indonesia market. And then large checks they grew, but not quite as much as you saw in the middle over here. In contrast, Southeast Asia, excluding Indonesia, small checks grew quite robustly. The middle of the market was actually very, very moderate in its growth. In fact, the idea of a capital gap remains over here relative to, say, what you might find in the other parts of Asia, like China, on a dollars deployed per dollar of GDP basis. And then the very large end of the market, again, ebullient, much as it was in China and India at that size tier. This is super interesting from our perspective. You're seeing a little bit of a tale of two cities inside of Southeast Asia, with Indonesia mid-market extremely white hot right now, and a bit less so for companies that might be based in Singapore or Malaysia, but pursuing regional strategies. So it goes back to the heart of that strategy 1 versus strategy 2 dichotomy that we really favor. To a certain extent, there might be a bit more value right now in strategy 2, in as much as there's great growth in strategy 1 as well on the supply side. And I won't bore you with the details of how these charts manifest out, but if anyone would like a copy of these in terms of how it looks, I'll just for a moment drill into that one chart that again looks at 2021 versus 2019 and versus 2020. Just the growth, the magnitude is just enormous in Indonesia specifically in that mid-sized check segment. Whereas if you look at Southeast Asia, excluding Indonesia, it's a much more modest gap. And we find that very interesting in terms of much more modest growth. We find that very interesting in terms of valuation and supply demand of capital in our region. Finally, to conclude, as many of you know, we are not big fans of the unicorn moniker. We love the rhino concept, not just because it's kind of a cute story and a bit of a tongue-in-cheek thing, but genuinely, there is something very special about making something out of very little and having enormous productivity of capital. And I want to emphasize something right now. The overall global equity capital markets appear to be fairly richly valued at the present day. Here's a way to look at it. It's what Warren Buffett loves to analyze. Market cap divided by GDP. He looked at it for many years in the US context, but over time, I think there's a good argument that you have to look at it globally, because the market cap of so many American companies is indeed a function of international operations. You'd be dividing oranges by apples or apples by oranges. This corrects for that. This is global market cap divided by global GDP. And you'll see that the ratio peaked at 107% just before the global financial crisis. It troughed at 42% during the darkest days of 2008 and 9, and it is currently 127%. Even if you adjust this to look at global market cap divided by next year's market cap, like a forward price earnings multiple, it again is higher than it certainly was at the peak right before the global financial crisis. The data set, unfortunately, doesn't go further back in time. This is worrisome. I'm not terribly worried about, again, that Southeast Asia, Series C and D, ex-Indonesia, because that's actually a relatively capital undersupplied area. And in general, I'm still quite positive on Indonesia on a longer term basis relative to global opportunities. But on a global equities basis, for those that have a global portfolio, this should be cause for concern. In fact, one of the things that we did is we looked at the global journey of market cap over the last roughly 20 odd years, and we simply normalized it against a simple trend line. We looked at when it was above that trend line, that little gray line you see over here, and when it was below. And what's really interesting is what we all learned in high school physics, Hooke's law. You pull a pendulum, it will swing back in the opposite direction in equal amount. Pull a spring and so on. You see that happening here, partly by construction, because it is, after all, a median sort of best fit line, but it is oddly and eerily symmetric. 49, 44, negative 28, positive 28. And all we'd say is the bigger they are, the harder they fall. At some point, this will whipsaw back, and it's important to think defensively about where do you want to be allocating capital in that environment. One fun way to think about that is to look at the last two recessions, where the dot-com recession of 00 to 02 over a 3-year period. The recession wasn't all of that, but just to sort of include the entire period from equities perspective. Ditto for the GFC. If you think about how many companies, just number of companies above a certain scale, achieved at least a sustained 30% IRR in their share price, the US dominated that in the dot-com recession. China dominated it in the global financial crisis. And you began to see a wider variety of emerging markets, including some of our countries here in Southeast Asia and greater Southeast Asia. We're really curious if there is a whipsaw downwards. It might not be a recession per se, but it might be a capital markets event. Would there be as many emerging markets? And there's an argument to say, yeah, actually Southeast Asia might be quite favorably inclined on this page. With that, we'll just leave you with a final thought. Marrying all these thoughts together, overvalued or undervalued markets, what is timeless is that the most successful companies do a lot with a little. 70% of the world's largest software and internet companies got to where they are or where they were at one point by spending less than $100 million. This is indeed the ultimate test of skill, and it persists over the life of the company because founders with that mindset and that DNA are able to build incredibly valuable franchises. With that, it's very nice to spend the time with you, and I'm looking forward to hearing your thoughts. Drop us an email anytime you like. See you soon, and stay healthy. Bye-bye.
All right, thanks so much, Nick. And well, you heard him. If you want to reach out to him, just drop him an email. And yeah, you can connect with him. But I hope you enjoyed that session. Look into the next few years in this ecosystem. Up next, we got a little bit of a learning lesson from a VC who became a founder and then went back to becoming a VC. So catch that right after this.